Okay, welcome to episode 10 of my 11-part series of the hard landing and why I think we are entering a recession. This episode is on catalysts, and I really wanted to make this own video because, I could talk about this recession coming all I want, but there's typically something that jolts it, okay? Something that really catapults it down. And a lot of the times, people don't really ever think of what it is, but then after they're like, oh, we should have saw that coming. So I'll just talk about some of the huge risks in the economy that could cause a sharp decline in GDP and such. Okay. So let's start with banks. I think a lot of you have heard that banks are in a sticky situation. And in 2023, we almost had a catastrophe. Silicon Valley Bank failed, Signature Bank failed, First Republic Bank failed, and a couple others. And these were these were because of bank runs. And I'm just going to kind of explain why this happened. So ever since 2008, banks have kind of de-risked, at least compared to what they were prior. So instead, they've tried to find safety in investing in treasury bonds. And when the government issued all of these stimmy checks during the pandemic, a lot of people had all this cash, right? So they went and deposited that cash into their checking accounts. Now, these banks have all this cash now just sitting in their bank, and they're like, well, we got to do something with this. We got to deploy this capital somewhere and make some money off of it. Well, what's the safest thing we can do, in their eyes, is invest in 30-year bonds. It's safe. It's the safest thing to invest in if you can wait the 30 years, right? Because what's interesting about bonds is that if the rate of the bond goes up, the value of the bond goes down. And that doesn't matter if you wait the whole 30 years and then get paid. But if you want to sell that bond prior to expiration in the secondary market, you have to sell it for what it's worth. And the reason that the value is the inverse of the rate is, say I buy a 30-year bond at 2%. I get a 2% per year. And then the rates rise to 5%. Okay, who's going to buy my bond when they can just go to the government and get one at 5%? Mine's only yielding 2, theirs yielding 5. So the value goes down, and the value goes down the greatest the longer the duration, right? Because you have that 3% for 30 years, right? So you got to compound that each year. Whereas if it was just, 3 months, it's not that big of a deal, really. It's like, okay, 2%, 3% difference for that short amount of time. Whereas the longer dated bonds, it's a way bigger deal. So the value of your bonds decrease much more in relation to the rate increase. Or decrease. So that's essentially what they did, is they put a lot of this money in 30-year bonds, and a lot of the investors got wind of this and realized that, well, they don't have our cash, basically. And this is what happens with bank runs, is that banks, they're only required to have, around 10% in reserves. So if $1 million was in the checking accounts, and they're allowed to loan out 900,000 of that and keep 100,000 reserves, roughly. Ever since the pandemic, though, they've actually cut that reserve to 0. So, these banks can just basically have no reserves if there's bank runs. And this is what happened. People came to get their money, and they're like, we don't have the money. Okay, and this is just a fault of our banking system, and this is how the whole world works. It's called fractional reserve banking. It just doesn't make sense, but it's how we live. They say that the actual reserves they have. The FDIC insurance is only like 1% or something, 2% of the actual money they're promising. Either way, people came to get their money, and they came so fast and so hard. This bank run happened so quick that the Federal Reserve couldn't step in and help them, right? Because in 2008, they performed quantitative easing where they basically bought those securities back. So they could have bought those treasury bonds back from them and given them cash. And what they actually ended up doing is they had this BTFP program where they basically gave them loans for the value of the bonds the price they bought them at, not the price that they devalued to. So once these banks failed, the Federal Reserve came up with this program that said, okay, all of your bonds that have devalued in worth, we're just going to give you these loans that make them worth what they were when you bought them. Okay, so that really put a calm blanket on the whole banking system and really the whole economy, because people were like, okay, I guess these banks, would have the money if we came and got our money. Probably wouldn't, but either way, it happened so quick that the Federal Reserve couldn't step in fast enough, and these banks failed. Okay, so the BTFP just ended. I think it was in March. And what about all those bonds that those banks bought, right? The rates rose, so the value decreased. They still, the value of those bonds have still gone down. So that's where you see this U.S. banks are currently facing unrealized losses of $517 billion. So they don't actually have those losses unless they sell them. So that's why it's called unrealized. And if they can wait the whole 20 years or 30 years, whatever type of bond they are, the losses will go away. But if you need to sell those bonds, just say there's another bank run, you'd lose all of that value on those bonds. Okay, that's $500 billion in unrealized losses these banks are sitting on. So, I mean, really, if you think about it, it just takes one big bank run. I mean, really, ever. It just takes one big bank run. Here's the BTFP that I was just talking about, where when they had this crisis, look at all these loans that these banks took out to ensure that they were able to meet withdrawals. So that's essentially what happens. The Federal Reserve has to come in and bail them out, and that's just how it works. So just to show this is the 30-year bond, and it was down at 1.2%. And then when rates started to rise, it's gone all the way up to 4.4%, right, over the last 3 years. And this is the TLT, and this is the inverse. So this is the value of those bonds, and they've dropped 50%. Right? So as rates rise, the value of your bonds drop. Okay, and it only matters if you resell them. If you can wait it out, you're fine. So those are the banks. All right, that's just one. I mean, the whole banking system, it's just a trust system, and if one starts to fail, another starts to fail, and if you don't trust him, I'm not trusting you. It's a quick snowball, and you can really see that at any time. Now let's talk about real estate. This is directly because of the pandemic. Obviously, people stopped going into the office, and the commercial real estate, especially office buildings, is just crumbling. Office vacancy rate surpasses 20% for the first time in history. This is really sad, honestly. All these people that had these huge investments in these office buildings basically lost all their money. And you recognize this building. This is in St. Louis, the AT&T building. This was $205 million in 2006. So imagine how much it appreciated over the next 15 years. And then it just recently sold for $3.5 million. Okay, this building sold for $3.5 million. That's what, a 99% loss. So what are these trusts basically doing is they don't have the cash that if people were to withdraw, essentially. So like Starwood further limits withdrawals. The new restriction caps monthly withdrawals at 0.33% of net asset value. Okay, they manage $10 billion, and they're only letting people withdraw 0.3% of what they own a month. Okay, so they're basically not giving people the money that they own, due to the huge, basically, bear market in commercial real estate. And then what happens is you have fraud. So property fraud allegations snowball as commercial real estate values fall. This is just last week. This one up here is from May, but drop in values caused by higher interest rates and a rise in defaults exposes more schemes. This is just what happens. This is what happened in 2008. And, they tried to say it's secluded, it's contained. I mean, come on. How is it contained? It's all wrapped together. Who owns these real estate mortgages? It's banks. It's mid-sized banks. So the banks and the real estate are interconnected. I want to talk about Japan for a second and this possible scenario I heard. So there's this thing called the carry trade where Japan basically has these low interest rates and the US has these relatively high interest rates. So here in blue shows the 3-month rates for Japan. I mean, they're barely of zero. I think they're 0.1%. Okay. And the federal funds is right here at 5.3. So what people do is they borrow money in Japan and then they convert it to US dollars and just invest it in US assets, whether it's the stock market, US treasuries, just in money market mutual funds, you get right underneath this. And then when they're ready, when they have to repay their loan, they switch back and repay in yen. So this is what's been happening, and this is from November of 2023, where it's estimated Japan's government debt is a US $20 trillion carry trade. $20 trillion they've estimated has done this, and this is in November. I wonder how much it's gone up since then. So, what are the implications of this? Well, there's this theory of a reverse carry trade, essentially, where it becomes a credit crunch. Okay, and I just want to show, I guess prior to me talking about the carry trade, let me show you the devaluation in the yen versus the dollar. So when people borrow in yen, they convert to dollars, and that basically devalues the yen versus the dollar because you're getting rid of yen and you're buying dollars. You have less demand for yen and more demand for dollars, and that causes the prices to diverge. And in the last 12 years, it's decreased 51%, and just in the last 3.5 years, it's decreased 35%. This is crazy devaluation, okay? And this is a lot in part due to this carry trade. And Japan imports 97% of its oil, and oil is bought in US dollars. Okay, so even though the petrodollar deal ended, oil is still bought in dollars. So think about this. If yen imports all of its oil in dollars and their currency is getting more and more devalued against the dollar, then it's causing their oil to be more and more. And then what if oil prices go up? It's causing the oil prices for them to go up even more. Okay, and oil is life. Energy is life. It's the standard of living. You have to have energy. Okay, and if oil goes up, something's going to happen. Something's going to have to happen. And this is a theory from Michael A. Gayed. And he basically believes that there's going to be a reverse carry trade where the Japanese government is going to have to save their currency, that they're going to sell a bunch of the US treasuries they own to buy yen. So they're going to sell dollars and buy their own yen to, create more demand for yen, driving the price, the yen to USD price up. And he thinks that possibly the US may even have to get involved and basically buy yen to save the yen. And think about what this does is that if people that borrowed in yen start to see the yen to USD start to go back up, right? They've been going down this whole time. What if it starts to go back up? This will make a lot of people nervous that borrowed in yen, because the price of the money they owe in yen is going up, right? Because the value of the yen to the USD is going up. So they're having to pay back more and more money. So what they do is they sell their US assets and then go convert it to yen and repay their debt before it gets bad. This is pretty much called a short squeeze. And this is what he thinks is going to happen. He thinks this is the credit event that is going to completely turn over the whole economy, where money's easy now, but when this reverse carry trade happens, money's going to completely crunch and go back into yen to save the yen. And you might say, well, why do we need to save the yen? Well, Japan is the third or fourth largest economy in the world. Okay, they're huge. And it's actually bad if a currency devalues too much against yours, because think about it. People in Japan won't be able to buy the goods that you're producing. If their value keeps getting so devalued against yours, they'll stop trading with you. So, and you don't want that. You need trade. You need to be able to sell to them. So this has happened before, the Plaza Accord. So basically they met up to devalue the dollar against the yen. And this is just one theory, I guess, out there that could be a catalyst to this recession. And the last one is China. Second to last. China has been rough. This is just on July 11th. 40 Chinese banks vanished during a single week in June. Just blip. And China in March was actually experiencing deflation. Okay? That's a huge sign of economic downturn. And then they have a huge housing problem. It has nearly 4 million apartments that no one wants to buy. So China is really, really going through it. And it's all interconnected. The whole globe is interconnected. And there's a theory that the reason that this happened is because of the Japan issue, is that people were buying in yen at very low interest rates and then converting that currency to build these this real estate, and then basically no one used it, and they're going through it. So it's all interconnected. This is just China's breaking. It could just be one of the first few. I talked about this in the stock market video, but these are credit spreads. This is the junk bond yields and 10-year yields. And when junk bond yields rise and 10-year yields drop, you typically get that recession right here. Rise, drop, recession. And this shows the difference. When you rise, you get a recession. You have a lot of false positives, but keep an eye on this credit spread. If this ever starts to rise quickly, just know, something's about to happen. Also, there is I just want to talk about the Fed funds rate for a second, because this increase in the Fed funds rate was the fastest increase in modern history. Look at how fast this rose compared to everything else. 04 to 06, the late 80s. Okay, so just think about what's happened. Everybody got locked into their houses, couldn't spend money into the economy. We had a quick, short recession. And then they rose rates at the fastest rate ever and have just kept them there for years. I mean, not years, but over a year. You don't do that without something breaking, right? And nothing's really broken because everybody's got these fixed rate, long 30-year mortgages. So, you know, they're not moving. The real estate market's stagnant. And it hasn't really affected the people that locked in those lower rates. It's affecting businesses now, finally. But something is bound to break, right? And, you know, I think that the Fed is maybe just waiting for that to happen. And the longer they wait, you know, the harder that break is going to be, in my opinion. Lastly, I just want to mention black swans, is that a lot of the time, you know, prior to, say, a war or a big downturn, there's a black swan. And what this means is no one ever, it always comes as a surprise. And then people later say, oh, in hindsight, you know, we should have seen that coming. You know, it was right in front of our face. It's a black swan right in front of our face. So, you know, it could just be something out of nowhere that no one expects. I mean, just last week, you know, Trump almost got assassinated. But it could have been that. I mean, just think about the stock market and the economy if that happened. And that's a black swan. So you never know when these might happen, and you just got to be prepared in my eyes. You know, I can't just turn a blind eye and say, oh, you know, in the long run, everything goes up, right? It's like, okay, but can you sit through 10 years of, you know, can you lose 90% of your net worth and ride that ride? I can't. So I guess this is why I'm preparing, and that's what I'm gonna show you in the next video, is how I'm preparing, what I'm investing in, what I'm hedging with. So be sure to check that one out. So until the next one, Godspeed.